DraftKings stock shot up 9% when the infamous governor of New York announced he wanted legislation to allow for mobile sports gambling in the Empire State. DraftKings recently became the largest position in my portfolio thanks to an options play, which I will talk about later in this video. 19.5 million people currently live in New York State. That's a lot of potential customers for a state that loves bad sports teams. DraftKings is a daily fantasy sports and sports betting operator headquartered in Boston, Massachusetts. They allow users to be able to get into daily or weekly contests from basically any sport, and we're talking MLB, NHL, NBA, NFL, Premier Soccer League, MMA, Canadian football, tennis, and my favorite sport, NASCAR. Yep, it's definitely a sport, alright. And many, many more, including esports. In a That's So 2020s move, DraftKings became a publicly traded company in April 2020 through a SPAC, and it's already ballooned to a nearly $20 billion market cap. New Jersey legalized sports betting in 2018, and residents in New York would flip across the river to make bets in New Jersey, as 20% of all betting revenue came from visiting New Yorkers. So rather than seeing tax money pour into the neighboring state, New York now wants to see this money in their own pockets. Now the easiest way for you to get that green in your pockets is to hit that like button and subscribe to the channel. This is what more and more states will do as they realize sports betting is always going to be inevitable. If done correctly and in moderation, this can lead to a fun time and sometimes, just sometimes, even profits. I used to be a big time DFS person myself and used to make some of that Patrick Mahomes money. Luckily, we don't need to have Mahomes' arm to make some of that great gains on DraftKings stock. The pandemic has hit states hard as they've basically closed down businesses and economic activity, which was going to lead to less tax revenue. So why not try to recover some of that from sports gambling, which can be done on a smartphone? People will always love sports, and it feels like DraftKings and FanDuel, it feels like they sponsor every halftime show known to man. And it's definitely something people communicate via word of mouth. Remember, the house always wins, so that's a pretty good business model I'd like to invest in. Now let's take a look at some more reasons why I'm bullish on DraftKings. The first is the increased global movement on legalization. Sports are played everywhere on this planet, and even Kim Jong-un, I heard he's a huge basketball fan. This is really just an endless customer base. Analysts are already expecting this to be an $18 to $23 billion industry within the next 5 years. Back in March, these were the states with mobile gambling legislation already improved, and then the ones in orange have legislation that's being looked at as we speak. Now, DraftKings already has over 1 million monthly unique payers, who are people with high engagement in paid contests. There's also iGaming, which is more of the gambling that you would do at a casino, which is going to be done virtually now, so you can play blackjack, poker, etc. And you can see the compound growth that has existed for it in New Jersey, and the $21 billion the US market could have one day. I wasn't kidding earlier when I said it feels like DraftKings sponsors everything. They're like the Tai Lopez of sports advertising. They actually have very sophisticated data and science to back up what they spend money on and why, and that's to maximize ROI to get more people to remember and use their product. Well, it really seems to be working, as DraftKings is what most people think of when they think about daily fantasy sports, and it also is the highest preferred app of choice. Looking at their financials, we can see the revenue has basically doubled in Q3 of 20 versus Q3 of 2019. And for the year, they're also up pretty big as well. They spend a lot of their money on marketing and product technology to keep their apps looking sleek and top-notch, so this is not yet a profitable company. As for the year, they've actually lost $500 million just this year. But looking at their balance sheet, they actually have $1.1 billion in cash on hand. They actually recently just raised $1 billion, so this should be enough to keep them afloat for quite a while. Even better is that their balance sheet looks very clean, with total assets totaling $2.5 billion compared to their liabilities of just $500 million. That gives it a very strong 2.9 current ratio. Analysts are also very bullish on DraftKings. We can see here that it's currently a moderate buy with a 4.29 rating based on 21 analysts. It also has a median price target of about $56, which is actually higher than what it's currently trading at. MarketBeat has them at a 10% upside from its current price, and you can see the sentiment and strength of that share price continuing to go up as the time has progressed. It continues to go in an upwards trajectory. As promised, DraftKings actually did become the largest position in my portfolio this past week, as I had a put expire in the money on New Year's Eve at a $47 strike price. So the way that you can read this is basically I was paid $27 to buy 100 shares of DraftKings stock at $47, and that gives us a total value of $4,700. But at the close of business on December 31st, DraftKings was actually even lower than my average cost. It was $46.56. And that, of course, is always the risk of doing options. But right away, I figured I would flip it. So right when we got back from the new year, I sold a call at a $48 strike price, and I got paid $93 to do that. So DraftKings this past week easily blew past my strike price of $48, so they actually ended up closing for the week at $52.20. So I made $100 in short-term capital gains, but the risk of all this is the upside that I lost. So I had to sell these shares at $4,800 when they were really worth $5,220. So yeah, it would have been smarter for me to just keep the shares in hindsight, but unfortunately I can't yet predict the future. So I was more than fine just picking a strike higher than my average cost and unloading the shares. This strategy is called the wheel strategy, and I used it to make $220 on this DraftKings trade. So you can see here, the way that I calculated that was basically taking my call minus my put, which is $100, and then adding the 2 premiums that I was also paid. Of course, Uncle Sam is going to take 1/3 of this come tax time. So I made $220 in just 2 weeks, which isn't too bad because this money would have otherwise just sat around collecting dust. Plus, I have my actual capital back now, and I can repeat the strategy over and over again, possibly on Neo stock, which is the company that I'm going to be talking about in my next video. If you've enjoyed this video, please hit that like button and subscribe, as these videos take a lot of time for me to research and produce, so this is the best way that you can help a small-time YouTuber like me out. Also, please share your thoughts and opinion on DraftKings stock below. Also know that this is not financial advice, only for educational purposes only. Please always do your own research and consult with a financial advisor.